It's student loan week. You get a loan, you get a loan, you get a loan, and you get a loan. Yay! Oh, wait, that's not as fun. You know how Oprah gives away stuff? That was cool. That's like the stuff where, right? Do you remember that with the cars? Oh my God, that was such a moment in the 90s. That's my jazzercise for the day, by the way. Now I don't have to work out. Anyways, student loans. Wow, yeah, everyone has them. So as a lender, I see them on every credit report. When I don't see them, I'm actually like, hey, how'd you pay for school? Like, can I talk to your parents? Like, do they want to be my parents? Like, that's awesome. But they're on every credit report. So it's definitely something that we need to talk about, especially since because of COVID, student loans, like the federal ones, have been put into a forbearance. So as a lender, when I pull your credit, the normal payments don't show up. It just shows up as a zero. But as a lender, I have to calculate for what your payments actually are going to be. And that's what we're going to talk about. Today, we're going to talk about Fannie Mae, Freddie Mac, what are their guidelines on student loans and what to be prepared for. So the first thing, guys, and look, you may be working with me, you may be working with another lender. I'm kidding. Regardless, you need to ask your lender, hey, did you calculate my student loan payments? Seriously, because what happens is everything's tech right now. So people fill out online applications. The computers are issuing pre-approvals. And I always tell everyone, like, yeah, that means nothing. It means nothing. If you fill out my online application and you get an immediate approval, it's a computer pre-approval. It means nothing because the biggest place the computer misses is student loans. So if your credit report pulls and it says the payment right now is zero, that's what's gonna get imported into the system. When the system's running desktop underwriting, which many of these online applications do for the bigger mortgage players, it's not calculating the way an underwriter is gonna look at your student loans. And if you have $100, $200, even $50,000 in student loans, it could be the difference between qualifying and not qualifying. So today I'm going to go over Fannie Mae and Freddie Mac's current guidelines. So this video is filmed in October of 2020. I state that because these are the guidelines as of now. In lending, guidelines change, guys. They can change on a dime. So it's very important that you speak with your lender. If you are concerned about this, verify that the guidelines are still accurate, okay? And if your lender's like, student loan guidelines? You should dump them and call me. Okay, so Fannie Mae and Freddie Mac. So how do you know if your loan's going to be Fannie Mae or Freddie Mac? Conventional mortgages, meaning 510, 400 or below, are 99% of the time going to be Fannie Mae or Freddie Mac. That's where conventional mortgages get sold. I just say like that 1% because maybe you're doing some bank statement program or a portfolio loan, but if you're doing a 30-year fixed under that price range, the lenders are going to be selling your loan to Fannie Mae or Freddie Mac, so that's whose guidelines we're going to be following. Now, there are specific parts of the country where those Fannie Mae and Freddie Mac loans are higher than 510, 400. California, there's quite a few counties where it goes up to 765. So that's not something for you guys to be super worried about, but if you're looking at $1 million loan, you're not going to be Fannie Mae or Freddie Mac, okay? Unless it's a multi-unit. So Fannie Mae, Freddie Mac, conforming loans, let's talk about it. So here's the deal. With Fannie Mae and Freddie Mac, if your loan says a specific payment on the credit report, we will go with that specific payment, okay? Now, if it says zero, because it's in forbearance, which is what I'm seeing right now, Fannie Mae, the way we have to calculate it is 1%. So if you have a $100,000 student loan, I am going to put $1,000 monthly debt into your liabilities, okay? Freddie Mac is only 0.5%. So with Freddie Mac, I'm going to be doing $500 as your monthly payment, okay? And let me check my notes real quick. Yeah, that's right. And I check my notes because, guys, this is like tricky. It's like, okay, one is hitting you with 1%, the other one's hitting you with 0.5%. Okay, so far, I would say if you are worried about your debt to income, Freddie Mac is winning, right? They're winning so far. Now, if you're in a income-based repayment plan, okay? If you're in an income-based repayment plan, they will both take whatever that amount is. However, If it is 0, Fannie Mae will go with 0, but if it is 0, Freddie Mac will go with 0.5%. Okay, so now Fannie Mae is winning. So if you're looking at it from, okay, I'm not an income-based repayment, I'm worried about my debt to income, Freddie with the 0.5% is going to be the least brutal to you. If you're in an income-based repayment plan, Fannie is going to be the least brutal to you. Okay, now you're a borrower. Why do you even need to know this? You don't really. However, you do if the lender you're working with is not up to date on their guidelines. Because what happens a lot is people go, oh, well, they said I don't qualify because of my student loans. And we'll look at it and we'll be like, it's fine. And it's as simple as us going to Freddie instead of Fannie or Fannie instead of Freddie, depending on what the situation says. That's all we're doing. So it's really important that you're working with a lender that knows their guidelines, okay? I think that was the big, I'm just looking if there's anything else critical on conventional, because we're going to do VA tomorrow and FHA on Thursday. You know what, we can just do FHA today. So FHA is a little bit weird. FHA is super brutal. So basically the way that it works is even if you have a payment on your credit report, so let's say your payment is $200. Let's say it's a $200,000 student loan. Ooh, that hurts. And your payment's $200. Well, if you're doing an FHA loan, they're going to say, that's great that your payment's $200, but we're actually going to hit you with $2,000. $2,000. Yeah, $2,000. So FHA on student loans is actually the most aggressive in terms of how much of a payment they hit you with between all three. The reason why people end up doing FHA loans is usually because of a higher debt to income or lower credit scores or something like a short sale or a bankruptcy in the past, or they're trying to push over a conforming loan limit and do 3.5% down. So the student loans can be a real sticky point if you're like, well, my debt to income's higher, I'll go with FHA. It actually may be even higher than if you had gone with conventional because of that 1%, especially if you have a low payment on your student loan already. So the key thing about this is you need to make sure you're working with a lender that understands student loan guidelines and how to utilize them to your best benefit. Now, if you're like, well, gosh, it says 0 payment right now, why won't they just do that? It's not realistic, guys. We all know it's not going to be 0 forever. I don't want to get you in a house and then you start getting student loan payments and you can't afford your house and you're calling me crying. That's horrible. So I do think there's a good reason for all these guidelines. It's just important that the lender you're working with knows about them and utilizes them accurately. And the biggest thing I see right now, and my team and I talk about it every single week, because when the apps come over to us, if you're not digging into that credit and calculating those payments, it is the difference. It can be the difference between an approval and a denial. And sometimes those student loans are buried in the liabilities. So if you're working with another lender, and you've done an online application, you really do want to reach out and say, hey, I'm so looking forward to working with you. I just wanted to make sure that you hit me with student loan payments. And if they go, what do you mean? Just be like, well, I was just watching this video and it said that because of forbearance, a lot of stuff's coming over to lenders as zeros and sometimes lenders miss it and then it could affect my debt to income and I might not qualify. And if they say, oh yeah, we already did it, great, cool. But if they're like, oh, call it out, guys. Sometimes you have to be your own advocate. And I would say with all the stuff that I'm seeing in lending right now, lenders are doing the best that they can, but we're having stuff thrown at us every single day. So it is possible that someone could slip and not calculate it, and it could be the difference between you getting that house or not. So you want to make sure that your lender's done it. And then if it's not working, you want to make sure that they're exploring programs that are a little bit more friendly to your personal student loan situation. So I hope this has been helpful. If you are a veteran, tomorrow we're talking about VA and student loans.